OG Shawn AG here, and you need to pay attention to what's happening right now, because the silver story just got a lot bigger than price went up, or price went down. A low-profile Chinese billionaire trader just placed a massive bet against silver, about $300 million on the short side, right as the U.S. is moving pieces on the chessboard that scream one thing: control the physical supply chain, break the old pricing game, and stop any single player from squeezing the West out of a critical metal. Let's start with the headline that got everyone talking. There's a Chinese trader, Bianing, who reportedly built a reputation by leaning hard into gold at the right time and walking away with billions in gains. Now he's turned his sights on silver. And he didn't do it quietly. He put on what's being described as the Shanghai Futures Exchange's largest net short exposure in silver, a position now sitting around that $300 million number. The size matters. Roughly 30,000 contracts, estimated around 450 tons. That's not a retail bet. That's not, "I have a hunch." That's a statement. And when silver sold off hard, down around 16% in the recent drop, it didn't just look like a good trade on paper, it boosted the profit on that short. Now, if this was only a story about a billionaire timing a pullback, we'd shrug and move on. Big money shorts, big money longs, markets swing, life goes on. But the timing is the part you cannot ignore. While this giant short position is being built, the U.S. administration is simultaneously pulling together a major international push around what they call critical minerals. And when people in government say critical minerals, understand what they're really talking about. Metals you can't run modern industry, defense systems, and supply chains without. In this context, silver is sitting right in the crosshairs because it's both industrial and monetary, both strategic and scarce, both essential and tradable, meaning it's the perfect battlefield for a price war. We just saw a ministerial meeting where Vance and Marco Rubio hosted representatives from 54 countries to talk about critical mineral supply chains, coordination, and pricing mechanisms. That's not a casual coffee chat. That's a signal. When you gather that many countries in one room, you're talking about alignment, how to source, how to refine, how to stockpile, and how to avoid being held hostage by concentrated production and concentrated control. And the language coming out of that meeting is what should make your ears perk up. Vance emphasized that while everyone's obsessed with digital economies, AI, and tech, the real world still runs on real stuff you can dig out of the ground, refine, ship, and store. In other words, you don't build the future on vibes, you build it on physical inputs. He also pointed out that the group in the room represents roughly 2/3 of global GDP. That's not a small club. That's a large chunk of the world deciding it's time to stop playing by rules that keep domestic industries weak and supply chains fragile. Then came the part that matters for silver investors and anyone watching this market honestly. The admission that the current pricing environment for critical minerals isn't working. The idea presented was that international markets are failing to support sustainable domestic industry and secure supply chains. Why? Because supply chains are concentrated, prices are persistently suppressed, and the pricing process is influenced by forces outside the control of individual nations. That's a polite way of saying the price you see on your screen isn't always a clean reflection of physical reality, and that disconnect discourages long-term investment. Mining projects stall, financing becomes harder, production doesn't ramp the way it should, And then everyone pretends to be shocked when shortages show up. If you want a simple translation, here it is. If prices are unstable or artificially depressed, it becomes nearly impossible to build the long, expensive pipeline needed for mines, refining, and downstream manufacturing. Capital hates uncertainty. Capital hates whiplash. And when the market structure produces erratic, unpredictable pricing, projects die on the vine. So the stated goal being floated is to create more stable conditions, pricing that can support domestic supply chain development instead of constantly undermining it. That matters because it's not just some commentator on the internet saying the market is distorted. This is policy-level language. It's the kind of language that precedes action, incentives, restrictions, stockpile programs, strategic partnerships, and yes, attempts to create a more dependable price floor that encourages production and discourages predatory control. Now layer that on top of the physical reality we're seeing. Because while paper price gets slammed, physical signals keep flashing red. An Australian bullion dealer, City Gold, reportedly paused retail silver sales because of a global shortage, not because demand was a little hot for a weekend, but because sourcing became difficult enough that the responsible move was to stop selling temporarily. When a dealer halts sales, that's not theoretical. That's inventory stress. That's, we can't replace what we sell fast enough at a sane price. Then you've got India's MCX hiking margins, silver margins up around 7%, gold margins up around 3%. And listen, exchanges don't raise margins because everything is calm and orderly. They raise margins when volatility is rising and positioning risk is getting dangerous. Higher margin requirements force traders to post more collateral, which can trigger liquidations. And here's the key point. If gold were the primary stress point, gold would be punished harder in margin terms. It wasn't. Silver was. That's the market quietly telling you where the strain is. This is where people get confused. So let me make it simple. When margins go up, the exchange isn't saying, we care about protecting you. They're saying, we care about protecting the plumbing. The goal is to reduce the risk of a cascade, because when too many traders are on the wrong side with too much leverage, one violent move can break things. So if the system is tightening the screws more aggressively on silver, it's because silver is the one that can snap the chain. Now look at the delivery data people keep glossing over. COMEX delivery notices in silver continued to come in, with another batch issued midweek, pushing total deliveries higher early in the month, even though it's not the main delivery period. We saw major institutions issuing and stopping deliveries. In gold, delivery notices also rose, with big banks active on both sides. The point isn't that deliveries exist. Deliveries always exist. The point is that physical demand is staying persistent, while the paper market is getting whipped around like a rented mule. And then there's the word that triggers every serious metals watcher. Backwardation. Silver was reported trading in notable backwardation, spot priced above the front-month futures by around 80 cents per ounce after that historic slam. Backwardation means you're paying more to get it now than to get it later. In a normal, comfortable market, futures trade above spot, because time has a cost: storage, insurance, financing. When the curve flips, it's often a sign that immediate physical is tight, that supply is stressed, and that holders aren't eager to part with metal unless they're paid up front. It's the market's way of whispering, yeah, the paper price is down, but good luck getting size delivered without a premium. So while a billionaire short looks smart on a chart, The physical market is flashing something else. Urgency. Now widen the lens, because silver doesn't live in a vacuum. At the same time, risk assets have been getting hammered. Crypto was sitting near a record-high market cap around $4.3 trillion back in early October. Fast forward a few months, and it's closer to $2.3 trillion, meaning roughly $2 trillion in value got vaporized. That's a massive drawdown, and it matters because when speculative assets unwind, leverage unwinds with it. Forced selling doesn't ask permission. It sells what it can, not what it should. That's why you can see metals get hit even when the fundamentals are strong, because in deleveraging events, correlation goes to 1. Everything bleeds. Stocks have also been reacting to weak labor data and growing uncertainty. Big indexes slid, and the story in the labor numbers is the kind of thing markets hate. Jobless claims coming in higher than expected, layoffs rising, job cut announcements hitting the highest levels in years, and companies becoming cautious about new hiring. When layoffs increase and hiring plans dry up together, that's a classic early warning sign. Markets don't wait for the recession headline. They price risk in advance. And then there's the dollar. The narrative floating around is that the US dollar has been weakening sharply, even compared to other major developed currencies, with several G10 currencies strengthening against it over recent months. The reasons being thrown around are the ones you'd expect: political uncertainty, aggressive and unpredictable trade policy, tariff threats, concerns about debt and deficits, and the always sensitive question of central bank independence. Whether you agree with every detail or not, the larger reality is that currencies move on confidence, and confidence moves on policy credibility and stability. If global investors start to rotate away from the sell everything else, buy dollars, trade, the dollar can fall faster than people think. Now tie that back into precious metals. When the dollar weakens, metals often find a tailwind, especially when inflation expectations and policy uncertainty rise. But again, in a short-term panic liquidation, metals can still get sold as traders meet margin calls and reduce risk. That's why you need to understand time frames. The short-term tape can be brutal. The longer-term structure can still be bullish. This is also where the geopolitical angle heats up. There were claims circulating that U.S. officials have heard chatter about China exploring settlement systems or digital instruments backed by physical commodities, rather than relying purely on a currency-based structure for international payments and reserves. Whether every rumor is accurate is less important than the direction of travel. The world is testing alternatives, and metals are always part of that conversation, because metals don't require someone else's promise to pay. And China's broader pattern has been widely discussed for years, reducing exposure to U.S. Treasury holdings over time while increasing gold reserves. The point isn't to argue over exact numbers in a single snapshot. The point is the strategic impulse. Diversify away from paper claims and toward physical assets that hold value across regimes and policy shifts. That's not a conspiracy. That's what great powers do. Now here's where people get emotional and start shouting, "Manipulation at every candle." I'm going to say it in a way that helps you trade and invest without losing your mind. Markets can be distorted and still be tradable. Markets can be chaotic and still be predictable. In one sense, leverage will always get punished when volatility spikes. When positioning becomes crowded, price corrections happen even in structurally tight markets. We've seen this repeatedly since the 2022 lows. Rallies get overheated, sentiment gets euphoric, paper positioning swells, and then the market pulls the rug to clear the excess. After that washout, the underlying trend often resumes if the fundamentals are still there. So what are the fundamentals right now? Tight physical conditions, persistent demand, signs of retail shortage in some regions, backwardation signaling near-term stress, and policy discussion shifting towards stabilizing pricing and securing supply chains. That's the bull case. What's the bear case in the near term? Crowded positioning got punished, margin requirements are rising, forced liquidation can continue, and a major player has a large short that may influence sentiment and momentum in the paper market. So the real question becomes, who wins this round and when? Does the billionaire's $300 million short ride the deleveraging wave longer, pushing paper prices lower and shaking out late longs? Or does a tightening physical market and policy-driven restructuring create the conditions for a squeeze that turns that short into jet fuel for the next leg up? Because understand this, big shorts work until they don't. If physical tightness intensifies and official policy starts supporting domestic production through predictable pricing and strategic partnerships, the paper market can get trapped. Not instantly, not by magic, but structurally, because the real world eventually demands real metal, and paper promises can only stretch so far before premiums widen and delivery becomes the real arbiter. Also, don't miss the timing element. There's an argument that the big derivatives smash in silver and related markets was conveniently timed ahead of that 54-country meeting. Whether you believe it was coordinated or simply opportunistic, the sequence is provocative. First, a heavy paper sell-off that cools the narrative and flushes leverage. Then, policy coordination around critical minerals pricing and supply chains. If you wanted to reset the playing field, you'd do it exactly like that. Wipe out the froth, reduce speculative excess, then introduce structural changes from a stronger negotiating position. Now let me talk directly to two different groups, because a lot of people mix these up and get hurt. If you're a long-term investor or a physical stacker, short-term price noise is exactly that, noise. Your thesis isn't, the price will never pull back. Your thesis is that supply deficits, industrial demand, monetary uncertainty, and policy shifts make silver strategically valuable over a multi-year horizon. If that's your frame, you don't let one ugly week rewrite your conviction. You focus on accumulating intelligently, managing your budget, and staying patient. But if you're trading paper, especially with leverage, then listen very carefully. These markets are unforgiving right now. I've said it 100 times, and I'll say it again. If you're over-leveraged, sizing too big, and trading without a plan, the market will humble you. Not because you're a bad person, because leverage is a deal with the devil in volatile conditions. You need a real strategy and real risk management. You need defined invalidation points. You need to know what you'll do if you're wrong before you enter. Otherwise, you're not trading, you're gambling, and the house always collects during drawdowns. And look around. It's not just metals. When everything is dumping, stocks, crypto, commodities, it creates an environment where even safe trades get liquidated. So if you're going to trade, trade like a professional. Cut size. Respect volatility. Don't marry positions. Don't get emotionally attached to a narrative. Narratives are fun until margin calls arrive. Now let's put the whole situation into 3 clean takeaways that you can actually remember without replaying this 10 times. First, a major Chinese trader has put on a massive paper short in silver. Around $300 million? tens of thousands of contracts, hundreds of tons in notional exposure. He's coming off a history of strong gold trades, and he's betting that this silver pullback has room to run, or at least that crowded bullish positioning can be forced to unwind further. Second, while paper price is getting punched, physical stress signals have not disappeared. Reports of dealers pausing sales due to sourcing problems, exchanges hiking margins, harder on silver than on gold, steady delivery activity, and a meaningful backwardation spread all point to tightness in the real market. That's the classic divergence. Paper says, relax. Physical says, good luck finding size without paying up. Third, the policy landscape is shifting in a way that could change how this market behaves over time. A 54-country, critical minerals meeting led by top U.S. figures, explicit discussion of dysfunctional pricing mechanisms, and the need for more predictable markets, and an emphasis on supply chain independence all suggest that the U.S. and its partners are preparing to restructure access and incentives. If that includes limiting adversarial control, supporting domestic development, and reducing reliance on concentrated supply chains, silver ends up being more than a trade. It becomes a strategic asset. So where does that leave you right now? It leaves you with a timeline problem. In the short run, deleveraging can push prices lower than seems rational. In the longer run, structural deficits and policy shifts can push prices higher than seems believable. The market is a tug-of-war between paper positioning and physical reality, and both sides have weapons. If you want my view, the clean way to think about it is this. The short term is a battlefield of leverage, liquidity, and forced selling. The long term is a battlefield of supply chains, industrial demand, and strategic policy. Don't confuse the two. Trade the short term if you have the skill, discipline, and risk controls. Invest the long term if you understand the thesis and can tolerate volatility without panicking. And one last thing. People asked why that 87.90 zone mattered on paper as resistance, and why we kept getting rejected there. You saw it. Repeated failures, then the pullback to the low 70s. That's how markets behave when positioning gets heavy. If you want, I can break down the technicals more. Occasionally, not every time, but when it matters. If you're here to learn and you're finding value in this, drop a comment with OG Shawn AG so I know you're real. And tell me if you want a deeper technical breakdown next time the chart hits a key inflection point. For now, do your due diligence, understand the risks, and stop letting hype do your thinking for you. A billionaire can be right on the short for a while. A government can change the structure of a market over time. Physical tightness can intensify even when the screen price falls. The outcome depends on timing, pressure, and who is forced to blink first. Know your time frame, build a plan that matches it. And whatever you do, don't follow anyone blindly, including me. Use your own brain.